in 1929, the stock market didn't just fall. It collapsed. 89% erased, 25% unemployment, banks shuttered, families ruined. Then 2008 arrived and we swore we'd learned our lesson. The housing market detonated, stocks plunged 57%, and retirement accounts bled out in real time. Millions lost homes, millions lost hope. But what's coming now isn't 1929, it isn't 2008, it's both, at the exact same time. And the tools that saved America back then, they don't exist anymore. People feel the tension building. They can sense that something is off. But most don't understand the scale of what's already in motion. Because for the first time in financial history, stocks, bonds, and real estate are all cracking together. Not one bubble, not two. 3 simultaneous blow-ups in a system held together by debt, wishful thinking, and denial. And here's the part nobody wants to say out loud. Central banks can't fix this. The government can't fix this. And the average American is more exposed than at any point in modern history. In 1929, only about 10% of households owned stocks. Today, it's nearly 60%. That means when the market falls, everyone falls with it. In 2008, the government could borrow its way out of catastrophe. Debt was high but manageable. Today, Washington is drowning in more than $36 trillion of obligations, twice the size of the entire U.S. economy in 2008, and rising fast enough to break records every quarter. And the one-play politicians always run, printing money, already blew up in their faces. We just lived through the worst inflation in 40 years. You felt it in groceries, in rent, in every bill that quietly crept higher while your income stayed the same. They can't print trillions again without lighting the currency on fire. So, here's the truth. No sugarcoating. 2025 isn't a recession, it's a breaking point. The end of a cycle that's been compounding for decades. A cycle that financial historians are calling the everything bubble, because everything rises together, until everything falls together. And when everything falls together, there is nowhere to hide. If you've felt nervous lately, if something in your gut has been telling you the headlines aren't capturing the real story, you're not imagining it. You were seeing the same early signals that preceded every major collapse in the last 100 years, only amplified. Overvaluation, leverage, blind confidence, and the belief that this time is different. But this time isn't different. This time is worse, because the last 2 crashes happened when policymakers still had options. Today, the options are gone. Before we go deeper, let me ask you something. If the tools that saved us in 1929 and 2008 no longer work, what happens to your savings this time? And more importantly, what happens to your future? Every generation thinks their moment is unique, that their economy is smarter, their leaders are wiser, and their technology is so advanced that old rules somehow no longer apply. But markets don't listen to confidence, they listen to mathematics, and math never changes. Look back through history, 1929, 1973, 2000, 2008, and you'll notice something eerie. Every collapse begins the same way. A period of booming optimism, a spike in leverage, a widening wealth gap, and a collective belief that the future will look exactly like the recent past. Economists have a name for this: normalcy bias. It tricks millions of people into assuming that because nothing bad has happened recently, nothing bad will happen tomorrow. That's exactly where America is standing today, right on the edge of the same cliff our grandparents and parents once faced. In 1929, technology was the miracle cure. Electricity, automobiles, radio, they were going to usher in a permanent era of prosperity. Newspapers proudly printed the phrase, "a new economy." Sound familiar? In 2000, the internet was unstoppable. Companies with no revenue traded like future trillion-dollar empires. Everyone believed we were entering a digital golden age. And in 2025, it's AI. Artificial intelligence has become the new religion of Wall Street. Investors have convinced themselves that because AI will transform the world over the next 20 years, stock prices can only go up today. But technology doesn't eliminate the cycle. If anything, it makes the cycle faster, deeper, and more violent. Because behind every bubble, no matter the decade, the same psychological traps repeat. Herd behavior pulls people in. Nobody wants to be the only one sitting on the sidelines while their co-workers brag about stock gains or crypto profits. Anchoring bias keeps them locked into unrealistic expectations. They saw a stock at $500, so they believe it should return there, even after fundamentals turn rotten. Loss aversion pushes them into denial. They'd rather hold and pray than sell and accept pain. This is the emotional architecture of every crash, not fundamentals, not charts, human psychology. And that's what makes the current moment so dangerous. The signs are not subtle, they're blinking red. But most people are frozen, because the same biases that blinded investors in 1929 and 2000 are blinding investors today. The pattern is repeating in slow motion, almost frame by frame. Overvaluation, off the charts, leverage, everywhere. Margin accounts, options, buybacks, credit cards. Wealth concentration, higher than 1929. Public confidence, sky high and completely disconnected from economic reality. But here's the twist. Even though the pattern is identical, the system is far more fragile. In 1929, few households were exposed. In 2008, the damage was mostly in housing. In 2025, every pillar of the modern financial system, stocks, real estate, government bonds, is overstretched at the same time. This isn't a new pattern. It's the same pattern that has toppled every bubble of the last century. Only now the stakes are bigger, and the drop is steeper. So let me ask you this. If history has never failed to punish the same mistakes, why would it spare us now? Start with this uncomfortable truth. If the stock market were a patient in the ER, every monitor would be screaming. The numbers aren't just elevated, they're historically dangerous. The S&P 500 is trading at a price-to-earnings ratio near 28, almost double the long-term average. Only 2 times in American history have we seen valuations this stretched, 1929 and the year 2000. And we both know how those ended. But 2025 has a twist, a structural fragility that neither 1929 nor 2000 had. Today, just 7 companies, Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla, make up nearly 30% of the entire S&P 500. That means a tiny handful of stocks aren't just driving the market. They are the market. If even one trips, the whole index face plants. And at the center of this fragile empire sits Nvidia, valued at more than $3 trillion, richer on paper than the entire German stock market. Its price-to-earnings ratio hovers above 65. Investors are paying $65 for every $1 of profit. That's not valuation, that's faith, that's worship. That's the same kind of blind devotion people had for dot-com stocks in 1999, right before the Nasdaq lost 78% of its value. Everyone knows AI is transformative. Everyone knows it will reshape industries, but that's exactly the trap. Because they said the same thing about electricity in 1929. They said the same thing about the internet in 2000. They said the same thing about housing in 2006. They were right about the technology. They were catastrophically wrong about the timing. And timing is what destroys portfolios. But let us talk about the psychology behind this madness, because the biggest bubble isn't tea and silicon chips. It's in human behavior. People aren't buying stocks because they're undervalued. They're buying because they're terrified of missing out. FOMO is the most powerful drug on Wall Street. When your co-worker brags about doubling their money on Nvidia or Tesla, when your cousin says his crypto portfolio is finally coming back, when every headline screams about the AI revolution, your brain fires the same reward circuits as gambling. That's herd behavior. Then comes anchoring bias, the belief that if Nvidia hits on $200 once, it should get back there again. Investors cling to past highs like life rafts, refusing to accept that what goes up can fall a lot faster than anyone expects. And the cruelest trap of all? Loss aversion, the instinct to avoid pain at any cost. People tell themselves, I'll sell when it bounces back. I can't take a loss here. I'll hold a little longer. But by the time they finally act, the damage is done. This is exactly how bubbles behave right before they break. A handful of stocks doing all the lifting. Valuations unhinged from reality. Investors intoxicated by hype. A public convinced they're on the edge of a new golden age. But answer this honestly. If a $3 trillion superstar misses earnings by even 5%, what do you think happens to the entire market? Because the truth is, when giants fall, they don't fall alone. They pull everyone down with them. For most Americans, a home isn't just a place to live. It's the safety net, the backup plan, the one asset they believe will always rise in value no matter what the economy does. But that belief is about to be tested harder than ever before, because the housing market isn't just expensive, it's historically distorted. Nationwide home prices are now sitting nearly 50% above their long-term trend relative to income and rent. That number should scare you. Why? Because at the peak of the 2008 bubble, the one that nearly took down global finance, homes were only 35% above trend. Let that sink in. The bubble that destroyed Wall Street was smaller than the one we're living in right now. But it gets worse. Most people don't even realize we are in a bubble because prices have been inflated for so long. Familiarity becomes comfort. Comfort becomes denial. It is the same psychological trap every bubble creates. If it hasn't crashed yet, maybe it never will. But residential real estate is only half the story. The other half is already cracking. Across America, commercial buildings are sitting half empty, ghost towers of glass and steel. In some cities, office vacancy rates are running 35% to 45%, levels no modern economy has ever survived without a crash. Entire towers financed at 3% interest are now facing refinancing rates of 7, 8, even 9%. The math simply doesn't work. Buildings that once generated healthy cash flow now can't even cover the debt payments. And when the math doesn't work, defaults begin. When defaults begin, banks take losses. And when enough banks take losses, the entire credit system freezes. If you think that sounds dramatic, look at what's already happening. Major commercial property owners, billion-dollar firms with decades of experience, are walking away from buildings, handing the keys back to lenders, and swallowing enormous losses. If the professionals can't make the numbers work, what chances do the smaller players have? Now I want you to picture a quiet American neighborhood in early 2025. A family of 4 in a tidy suburban home. They bought in 2022, when rates were still low but prices were brutally high. They stretched every dollar, maxed their savings, borrowed from parents, signed a 30-year mortgage because real estate never goes down. Today, their home is worth 20% less than what they paid. By next year, it could be 30% or 40% less, depending on the region. If either parent loses their job or hours get cut, they can't refinance, can't sell without taking a life-changing loss, and can't move to chase better opportunities. They aren't homeowners anymore. They're captives, locked inside a financial trap they never saw coming. And they're not alone. Millions are in the same position. Because when a bubble this size pops, it doesn't just hit wealthy investors. It hits ordinary families, the people who did everything right, followed the rules, saved up, bought a home, and tried to build a future. So ask yourself, if the asset you trusted most, your home, starts falling 30 to 50%, what choices will you actually have? Homes were supposed to protect Americans. Now, for millions, they're about to become the heaviest anchor they've ever carried.
For decades, investors have been told one simple rule: when stocks fall, bonds save you. It worked in 1929. It worked in 2000. It worked in 2008. Bonds were the last lifeboat when the ship started sinking. But in 2025, that lifeboat is already taking on water. The U.S. government tessuer of the risk-free asset is now carrying more than $36 trillion in debt. That's about 125% of GDP. A level America has only ever seen once, at the end of World War II. But back then, the United States had a booming young population, a manufacturing base untouched by war, and decades of explosive growth ahead. Today, the country is aging, productivity is slowing, and global competitors are stronger than ever. This is not 1945. This is a nation running out of financial runway, and the cost of that debt, it's already spiraling. Annual interest payments have blown past $1.2 trillion more than the country spends on defense, more than Social Security, more than any other item in the federal budget. Think about that. The United States now spends more paying interest on old debt than it does investing in its own future. And once interest payments become the largest bill in the room, there are only 3 ways out each, one painful. Option 1. Cut spending dramatically. That means government layoffs, reduced benefits, shrinking services, and a guaranteed recession. Option 2. Raise taxes dramatically, which would crush small businesses, reduce hiring, and slow the economy to a crawl. Option 3. Print money, which ignites inflation, destroys savings, and punishes every working American. There's no fourth option. No magical escape hatch. Every path leads to crisis. Oh, this is why bonds are falling right alongside stocks. The safe asset is no longer safe because the borrower behind it, the U.S. government, is struggling under the weight of its own promises. And the psychology behind this problem is painfully predictable. Politicians don't think in decades. They think in election cycles. Present bias pushes them to kick the can just a little farther every year. Loss aversion convinces them to avoid hard choices because hard choices cost votes. And so they avoid the medicine, delay the truth, and borrow more to buy time. But time runs out. You can see the pressure building in the numbers. Bond auctions struggling. Foreign buyers pulling back. The Fed forced to quietly support the market because yields spike every time they step aside. And here's the part that almost nobody is talking about. When stocks are crashing and bonds are crashing, the entire foundation of the American financial system is exposed. Because everything mortgages, corporate loans, pensions, 401ks, insurance companies depends on the stability of U.S. bonds. When that stability cracks, the ripple effect moves through every corner of the economy. And that's why 2025 feels different. Because this time, the safe side of the portfolio may fall just as hard as the risky side. Let me ask you something uncomfortable. If the lifeboat is sinking, where do you go? For the first time in modern history, the answer isn't obvious. And that's exactly what makes this moment so dangerous.
Crashes don't start with fireworks, they start with whispers. A disappointing earnings report, a regional bank quietly failing, a foreign conflict flaring up overnight, a missed vote in Congress on the debt ceiling. Nothing dramatic, nothing that screams danger, just a small fracture in a system already held together by stress cracks. But in a hyper-leveraged, overvalued, emotionally fragile market like 2025, a fracture is all it takes. Because once the first domino falls, everything speeds up. Imagine Nvidia missing earnings by just 5%. Not a disaster. Not a collapse. Just slightly weaker guidance. In any normal year, the stock might drop 8 or 10%. Painful, sure, but manageable. But in 2025, Nvidia isn't just any stock. It's 7% of the entire S&P 500. It's the symbol of the AI revolution. It's the backbone of market optimism. If that stock stumbles, the psychology shatters instantly. Algorithmic trading systems, the machines that now make up most of Wall Street's volume, don't wait. They don't ask questions. They sell immediately. Millions of shares dumped into the market in seconds. Nvidia drops 12%, then 18%, then 20%. The slide triggers margin calls across millions of retail accounts. People who bought stocks with borrowed money suddenly owe more than they have. Their brokers demand cash. They don't have it. So the brokers sell for them, automatically, at the worst possible moment. That forced selling pushes prices down further. Apple, Microsoft, Amazon, Google, Tesla, Meta, all fall in sympathy. Because when the story holding up the market crumbles, everything tied to that story crumbles too. Within 48 hours, the S&P 500 could be down 6 to 9%. Within a week, down 15 to 20%. And that's just the equity side. Now the panic spreads to bonds. Investors normally flee to treasuries in crises. But this time, treasury markets are already overwhelmed by trillions in new government borrowing. So instead of yields falling, they spike. Higher yields mean the government's debt gets even more expensive to service, which triggers fears of a fiscal crisis, which sends yields even higher. This is the doom loop, a snake eating its own tail. But we're not done. The next wave hits the banking system. Commercial real estate loans from 2014-2019, locked in at 3% interest, are now refinancing at 7 to 9%. Properties worth $100 million just 3 years ago are now selling for $55 million, if they sell at all. When those borrowers walk away, the losses fall on regional banks. The same kind of banks that failed in 2023 and early 2024 even before the recession began. Depositors hear rumors. A few lines on social media go viral. People pull money just to be safe. And in modern America, with apps, instant transfers, and 24/7 banking, a bank run doesn't take days anymore. It takes minutes. And here's the part that should terrify anyone with money in the system. The FDIC has roughly $125 billion to insure more than $10 trillion in deposits. If multiple banks fail at once, that fund evaporates instantly. The government would have to print hundreds of billions, maybe trillions, to stop the panic. And printing that much money reignites inflation overnight. Your savings survive the bank run, but die in the currency collapse that follows. Meanwhile, margin calls spill into pensions, endowments, hedge funds. Institutions dump assets to preserve liquidity. Layoffs accelerate as companies watch revenues collapse and credit freeze. One shock triggers another. One failure triggers the next. The chain reaction moves faster than any policymaker can respond. And most Americans, sitting at home, watching headlines, hoping it blows over, wanted to understand what's happening until they check their retirement account, and it's already down 40%. Ask yourself honestly, if the fire starts tomorrow, are you prepared for how fast it spreads? Because when the dominoes start falling, you won't have time to act. You'll only have time to watch. Every crisis has a clock. You may not see it hanging on a wall, but the hands are moving just the same. And right now, they're moving faster than at any point since 2008. If you want to understand why the danger isn't someday, but soon, painfully soon, you have to look at the most reliable recession predictor ever discovered, the yield curve. For 70 years, through wars, oil shocks, political chaos, and financial bubbles, the inverted yield curve has predicted every recession with zero false alarms. Not most, not almost all, every single one. It inverted in July 2022. And it stayed inverted for 27 straight months, the longest warning signal since the 1970s. That wasn't a bump. That wasn't a noise. That was a siren. But here's the part most people miss. Recessions don't begin while the curve is inverted. They begin after the curve goes back to normal, and that happened in September 2024. Historically, recessions begin 3 to 12 months after normalization. Not 18, not 36, 3 to 12. Do the math. That places the recession window somewhere between December 2024 and September 2025, with the market crash historically following close behind. But that's just one timeline. The second one is even scarier. More than $2 trillion in commercial real estate loans come due in 2025 and 2026. These loans were issued at 3% interest and must now be refinanced at 7 to 9%. For many buildings, refinancing isn't just expensive, it's impossible. The value has fallen too far. The debt is too high. The lenders won't approve the deal. That refinancing wall isn't a metaphor. It's a deadline. And deadlines don't care about optimism. Then comes the consumer debt spiral, the third timeline converging on the same point. Credit card balances above $1.1 trillion. With interest rates averaging 21 to 28%, delinquencies rising to levels not seen since 2011. Auto loans stretched to 84 months, with defaults climbing month after month. When consumer spending is 68% of the US economy, and consumers are tapped out, the timeline is short. Painfully short. And if that weren't enough, the fourth timeline is coming from the people who know the truth before anyone else. Insiders. Jeff Bezos selling billions in Amazon shares. Mark Zuckerberg cashing out billions more. Nvidia executives unloading shares while the stock hits record highs. These aren't random sales, they're exits. Quiet, orderly, intentional exits. The same kind insiders made before the crashes of 1929 and 2000. And then there's Warren Buffett, the most patient investor in history, sitting on more than $325 billion in cash, the highest level Berkshire Hathaway has ever held. He's reducing stock exposure, trimming Apple, and buying short-term treasury bills. When asked why, he didn't hedge. Valuations are too high, opportunities too few. When Buffett waits, America should worry, so let's pull the threads together. The most reliable recession signal in modern history flipped from warning to countdown in September 2024. The largest commercial real estate refinancing crisis in U.S. history hits in 2025-2026. Consumer debt is breaking. Insiders are exiting. Buffett is hiding in cash. These aren't predictions. These are timestamps. And they all point in the same direction. A narrow window between late 2025 and 2026, where the system is most vulnerable. So let me ask you something simple. If the smartest money in America is preparing for impact, why aren't you? When the crash finally hits, it won't feel like a movie scene. There won't be one dramatic moment, no bell ringing, no headline that magically marks the beginning. It'll feel confusing, chaotic, slow at first, then suddenly violent. It always starts the same way. A tech giant misses earnings. A regional bank quietly collapses on a Thursday afternoon. A government report reveals unemployment ticked up faster than expected. At first, people shrug, because normalcy bias tells them everything always goes back to normal. But then something snaps. One domino falls into another, and the illusion of stability evaporates. Within weeks, the shockwaves hit every corner of daily life. 401ks shrink by 40, then 60, then 70%. Home values spiral downward. Job postings disappear, layoffs spread, credit freezes, small businesses shut their doors, renters can't afford rent, owners can't afford mortgages, banks ration withdrawals. The Fed stands at the edge of a cliff, print money and ignite inflation. Or let the system collapse into depression. People tell themselves it'll pass. It always passes. That's what the Japanese said in 1990. They waited 34 years. That's what homeowners in 2008 said. Some never recovered. And that's what millions of Americans in 2026 will say right before they realize the recovery won, to be measured in months, but in decades. But here's the truth most people never hear. A crash doesn't destroy everyone. It destroys the unprepared and rewards the ready. That's the pattern. In 1929, in 2008, in every cycle before and after. Those who survived had three things in common. 1. They had liquidity when others didn't. Cash isn't king for long, but during a crash, it is oxygen. And the ones with oxygen choose their opportunities while the rest gasp. 2. They controlled their burn rate. Families who lived below their means outlasted the storm. Debt-burdened households didn't. 3. They understood the psychology of panic. Herd behavior destroys wealth. Loss aversion freezes people in place. Normalcy bias blinds them until the damage is irreversible. But there's another side to this, the one nobody talks about openly. Crashes create generational wealth. Ask the families who bought real estate in 1933. Ask the investors who stepped in during 2009 when everyone else was terrified. Ask Warren Buffett why he's sitting on hundreds of billions in cash. Because the moment of maximum fear is also the moment of maximum opportunity. When markets fall 70%, when homes fall 40 to 60%, when businesses sell for pennies on the dollar, that's when fortunes are built. Not by the reckless, not by the lucky, but by the prepared. So what do you do now, before the window closes? You build liquidity, you reduce risk, you cut unnecessary debts, you protect the essentials, you create optionality, you stay calm when others panic. Because when the crash hits, you won't have time to prepare. Preparation is the luxury you only have before the storm. And one more thing. No matter how much wealth is destroyed in the coming collapse, one asset will matter more than any portfolio. Your mindset. A resilient mind survives crisis. A fearful mind watches opportunity pass in slow motion. You can't control the Fed. You can't control the markets. You can't control the government. But you can control your behavior under pressure. And that is what separates victims from survivors, and survivors from the next generation of winners. So let me leave you with a question. One that I want you to answer in the comments. And answer honestly. What worries you the most right now? The crash itself, or the possibility of not being ready for it? Because the crash is coming. The only question left is what you'll do before it arrives.